The following is a presentation of TFNN.
Good afternoon, folks. Welcome to our February 1st live webcast edition, our every other week program. And thanks for joining us. Looks like we've got many subscribers that are clients that are going to be listening to this on the archive version. And even for those folks that are on here live with us, I should have the archive version up. Shooting to have it up by 6 o'clock this evening. And not for any other reason other than so many folks are now beginning to join us on the archive version, just simply trying to get this thing up as soon as we possibly can. So the first piece of the webinar is where I just simply, especially welcomed all the new clients that we have. I just simply go through a number of slides, fairly repetitive, a little bit of housekeeping. For any new clients or existing clients, all of these webcasts are archived. And so you can just simply, underneath the Celestial Charting button, you just simply can go back and take a look at the archive. So there's hours and hours worth of training, information in there that will be useful to you to become aware of. And so I encourage you to be able to do that. And, each and every week, or every other week, I should say, I am trying to make this even more and more of an educational process, taking a look at either different patterns that are out there, whether it's ABCs, Gartley's, swing point tests, or even just simply the ability to go ahead and create your own expectancy table. So I did receive a few questions. But certainly I'll, as always, we'll take questions as we get to that portion of the session, and you just simply are able to go ahead and type in your questions. So today, February 1st, happy February for folks. There are 29 days in this month here, so we do have a leap year. And for anybody born on the 29th, happy birthday to you when we get there. Our next webcast, 2 weeks from today, the day after Valentine's Day. So please go ahead and set that on your calendar. They're always at 3 p.m. Eastern Time, and we will typically get off the air by about 3:55, so the production guys can get ready for the 4 p.m. Show. This first chart that I've got up here on my screen is our, in essence, the lunar trading strategy. I don't include this with each of the daily newsletters, but it has not been working, let's say, the best. Of course, the market's been relatively tight over the last really couple of weeks, just as you can see here, just really just edging up, if you will, quite frankly, ever since the middle of December, but just slightly edging up. And even as we do this program here right now, and we'll take a look at it, you've got the Dow's up about 125 points, and the S&Ps are up 15. And so here's our lunar trading strategy chart, and this maps out the 6 different cycles that we have been following. This page here, for anyone that is new, this next page that I show, this is the this is a copy of one of the pages out of the New American Ephemeris. I do recommend that each of you have this. It's a great tool to be able to go back to, a great reference tool. Starcraft Publishing is the one that produces this. There are others that are out there. I recommend the New American Ephemeris 2007, 2020 edition. There's the phone number, and I recommend that you contact them for that. What you have down in here, where my cursor is, if you will, you've got the moon phenomena. That is certainly one of the aspects that we talk about. So you've got even some of the void of course aspects that are listed down here that we don't really necessarily, I haven't been mapping out on the system. So you've got all the moon phenomena down there. More importantly, though, is the next portion, which is the bottom portion of the ephemeris, which is the daily aspectarian. And in the daily aspectarian by day, it identifies exactly planetary alignments. There is a key so you can determine, what the moon and the sun and the different planets that are there. What we really use this for primarily, if you will, has been what I was using this for in the past, was I would get to the month and I would count up exactly how many planet alignments were occurring on each day, and just simply go ahead of time and identify where there was a anomaly. An anomaly is where you have, and you'll see when we get to that portion of it, but anomaly was when you had a large number or a small number occurring on the same day. So that's for the daily aspectarian. We'll come back to that in a moment. You then have these lunar phases here. These are the primary lunar phases. They actually really are in order of importance. Normally what we do is we have been following the full moon, new moon strategy, if you will, along with apogee and perigee. We did have apogee occur yesterday or the day before. I can't recall now. Time just flies together. But I do have that chart, and we'll take a look at that, and the moon void, of course. So these are the different lunar phases, and you have all those aspects. I also am including that here today, and I believe that you can go back and take a look at this webcast, and you can stop it and jot down any notes that that would make sense for you. With regard to the aspectarian, there are major aspects. There are 5 major aspects that we track. These are the different angles, just like we use 1.618, 1.272 for expansions, and 618, 0.786, and 382 for contractions. There are alignments with regard to the planets that are out there. And in the aspectarian, these are the 5 major ones that we do take a look at. If you take a look at February, the month that we're in, our 2012 lunar dates. In this case here, what I've identified for you are all of the major lunar dates. What I've done is I've highlighted in red each of the ones that we've been trading in our lunar trading strategy. So you've got the next one that is up is February 7th, so that is a week from yesterday when we have the next full moon cycle. Obviously, we won't have a webinar, but from the newsletter service, I will let us know what our trading strategy is, just as I do each and every day, whether there's a lunar aspect or not. February the 11th on Saturday over the weekend, you have the moon at perigee. Come back on the 14th. You've got a third quarter moon. Then we've got the next new moon on the 21st, and then on the 27th, the moon at apogee. So those being the primary lunar phases that we have been following on our charts. With regard to for the entire 2012, and I'm going to flip through these relatively quick here. These are all of the full moons when they are occurring, so that you can notate that or go back and replay that. These are all of the new moons that are occurring through 2012. We then go on to the number of perigee aspects. And if you trade the futures specifically, if you're trading, now I typically lay this over the ES Mini futures. If you are trading the futures, the times that are here, just so I make sure I notate that, these are ephemeris times. And so during this time of the year, you would go ahead and back this up by 4 hours to get to Eastern Standard Time. And then when we go into Daylight Savings Time, obviously, you would go ahead and back it up by 5 hours. And if you are trading the futures contracts, what I would do is I would lay down a line right on the exact time of when the perigee and apogee aspects occur. Here are the apogee aspects, and what I would do from a trading standpoint is when the price is above the line, and I would do this for at least a 3-day period of time. When price is above the line, I would try to be long in my position or look for an entry point based on that. And when price is below that, I would look to be short my position. Again, these are more of a shorter term duration, but good for trading the futures contracts. You then have the moon when it is on the northern part of the equator. That is what these dates here are. You also have when the moon is on the southern part of the equator. That must be on the next chart. So here's the first quarter and third quarter phases. Again, for February, you already have that in the slide above. And then for the rest of 2012, this is the moon on the southern portion of the equator. This chart here, most of you are familiar with it. This is the work that I did on going back to the daily aspectarian. That was where we were taking a look at the major angles of the planets. And I went back and I have the data for 300 years, 1800 to 2100, and was able to create a database so that I know exactly how many occurrences there are during that time period, where you have, in essence, if we start in the upper left-hand corner, where you have actually zero, if you will, zero planetary alignments on a specific day, and that's happened 3 times in 300 years. I don't recall those dates off the top of my head. But what you work out here, and this is the work that was done by Larry Pesavento, Dr. Ruth Miller, and a couple of others many, many years ago. And these are the P-index dates, planetary index dates or Pesavento index dates. And the original work that was done is really this column right here. ET stands for ephemeris time. This was the original work that was done. And what Larry and Dr. Miller do is if they see an alignment with 3 or less or 14 or more, that is something that is very much notated on the charts that they would trade, and they expect some type of market turn. They don't expect the market turn to occur on that day at that specific time, but they do expect it to occur plus or minus a day on either side of the aspect. Since I have all the digital data, I've gone ahead and taken that one step further and backed it up to take a look at Eastern Standard Time. And so you can see here's the distribution of occurrences, if you will. I've highlighted the areas there that we pay attention to and that we take a look at. So as we take a look at February of 2012, what I have identified here is the only day here that we should be aware of from a planetary aspect standpoint with regard to the number of aspects occurring on a day, and that would be February 21st. And now this, as you can see, this is all based on the Eastern Standard Time Zone. If we were just simply using the work of the original work of Larry and Dr. Ruth, well, I see 14. Let me see here. I may have overlooked that. In fact, I did. So that day is in fact a planetary index date. So you will want to go ahead and mark that on your. Oops, I don't want to do that. You'll want to go ahead and mark that on your calendar. Of course, I'll be marking that for you. I just don't have a way to highlight that here. It looks like real easily. Oh, let me do this. Let's see here. Okay, that didn't work very well, did it? Good Lord. I actually made it worse, not better. That was not the intent. Let me try to do this here real quickly. So it just shows you that you shouldn't do that type of work on the fly. In any event, so you'll know that February 21st is the P-index date that occurs during the this month. But if you go back here and take a look at the P-index date, this basically, in essence, means, it's happening less than 0.5% of the time, over a 300-year period. So it really is an anomaly and something to be able to take a look at. And what we'll do is, I see some questions being posted here, and we'll get to those questions there, Dave, and any other questions as well. I had some questions sent in by email, so we'll probably get to those first. This is important to understand, and it's major conjunctive periods. I haven't spoken about it on the radio show, and probably won't until we actually get there. But in going back through the daily aspectarian, you may be familiar with the crash in 1987, and if you go back and you take a look at the crash in 1987, you'll see over a 1-week period of time where you had a number of planets that were conjunct each other. In this case here, you had 6 planets that were in conjunction with each other over a 1-week period of time. And conjunction, if I just simply come back here to this chart, just simply to put it in perspective for you, I'll come back here, and here are the major aspects that we take a look at. And conjunction, when they come back and line up with each other, versus opposition, when they are exact opposite of each other. And those major conjunctive periods typically have a significant impact on the market. And, of course, I know the normal question would be, well, why are you showing me 1987, Steve? We're in 2012. And so I will get to that. If you do take a look at the 1987 chart here, what you will see is the time period when this occurred, and then the what led to the crash of 1987. Now, look, I'm not predicting a crash. That is not the reason that I have put that up here. What I am putting up here for is because if you had a AAA triptych, this would be a very large detour sign to be aware of what is potentially coming. The next conjunctive period, and I could go back further, and as I could go back go forward. But the next conjunctive period that we had was in 2007. In 2007, this was a major period. We also had a planetary index date during this month here of August. It was during this time period here where this area had always held over a 200-year period of time, and once that area was broken, which was back in the September time frame, I believe August-September time frame, that was one of the indications that we were moving into a bear market phase. That was in 2007. If we take a look at 2011 here, you can see in February, from the 17th through the 25th, I did stretch it by 1 day. So that was a baker's week instead of a baker's dozen. And if you take a look at that time period, you can see quite a few conjunctions taking place, as is in the month of March, where you have 5 conjunctions occurring. And if we go take a look at our chart here, which we will, and we will punch up on the screen as soon as I find it. There we go. You can see that this really represented highs in the marketplace, the highs that, still to this point have not been taken out. And so we need to be sensitive to these conjunction periods. The reason why I'm getting and discussing this is because this is the only conjunctive period that we have in 2012. So it is coming upon us, if you will, and we'll need to be aware of this. Again, this is not necessarily going to be a date specific, so we'll be watching, other patterns that are setting up, maybe other lunar aspects that set up, and we'll be watching this, in essence, this week area here. So in a period of 5 days, we do have 4 conjunctions. In 2013, it is looks like it's going to be a wild ride because there are really quite a few. At least I think there are 3. I can't recall exactly, but I know that there are quite a few. But in 2012, this is from a conjunction standpoint, this is the only major one that we have. So that's the portion of the presentation with regard to any of the lunar aspects or planetary aspects. Are there any questions specific with regard to that before I move on? If there are, just go ahead and type them in, and I'll do the best that I can. And always, what I do want to make sure that each of you know, and most of you do, and you've taken advantage of this to the extent that you want to. You always have the ability to give me a call in the office. Or even on my cell phone. You know that's included in any of the emails. My email is steve@tfnn.com, and you have the ability to get in touch with me for whatever reason whatsoever. I don't know how many. Well, I know that there were a number of you that had signed up for the webinar that I did last Wednesday. That was what I'll call the general business growth webinar, but really it had a lot of other applications. That webcast is also archived on your members page. So if you haven't had a chance to take a look at that, I'd suggest that you do, or you replay it. They are great techniques that I have used time and time again, strategies, if you will, time and time again to help me grow my business, and I'm sure that there's something there. Or if you need some help or some ideas, then feel free to, like I say, always feel free to contact me. And by email, if I have not gotten back to you within 24 hours, please get back in touch with me, because something would have been overlooked. Maybe it went into a junk box or accidentally got deleted, or who knows what. But usually I'm very good about getting back to folks usually within the hour, but certainly within a 24-hour period of time. We will spend a little bit of time today, taking a look at the patterns that came from this gentleman here, H.M. Gartley, which were created, which were available in his books, Profits in the Stock Market. And so we will take a look at that. This page here is probably helpful for you to take a look at and pause, as it really helps to identify the pattern, how they should be traded. And, as I know each of you, either I make you aware of, that there are certain elements where you want to be careful when these patterns are setting up, as in the case of Apple. As an example, as you know, we identified a 1.272 butterfly pattern, and you have to be careful when you have a gap up near the completion point. So that C to D leg is very important to be watching because it suggests whether or not higher prices are coming. I did suggest, whether it be on the air or what have you, that it looked like in the case of Apple, since it had gapped up into that area, that the higher prices in the 350 plus range, 360 range, was the more likely target. And then as you're coming into that completion point, any wide range bars also will help you. Tail closes just simply mean that the market was truly pushed up during the day. It's like a version of a hammer candle, but you can't call it a hammer candle because the market was moving up. So we'll take a look at some of those patterns as well. Let's get into your questions. This is actually taken from H.M. Gartley's book on page 222, and where he really went ahead and identified that pattern. Now, what he was not using was he was not using the Fibonacci sequence. So he was not using that. That was an adaptation that Larry, I believe, put into it based on the work of just simply taking a look at the natural harmonic vibrations that exist in the market and how the 0.618 areas are logical places of fear and greed, if you will, just normal retracement. So that is what we look for. But by definition, you just simply need an A to B equals C to D. That would look something like this. That is moving back into the larger trend. The larger trend is really referring to the X point here, where you have a trend, in this case here, a trend to the upside. Let's say you have missed an entry on that, and what you wait for is you wait for the first A to B equals C to D. In this case here, a 1-to-1 A to B equals C to D, in order to go ahead and get back in on that position. And that would be considered a bullish Gartley, whereas a bearish Gartley is where you'd have a significant move down. This is what we're looking at now when we take a look at our markets, except we're looking at not the, in the case of the small caps, the IWM, this is exactly the pattern that we're taking a look at. And while the larger bearish Gartley has set up, we also have a bearish butterfly pattern. And so that's why I think that it's a great, unique time for us with regard to being able to see which way this market is going to turn. This doesn't happen that often when we have this many setups. It is one of the reasons why we're using buy stops on both sides of the trade. I feel comfortable that if the market does break one way or the other, we will have foregone a little bit of profit for the probability of being on the right side of the trade. And so we have both of those pieces set up. This is just simply a page from Gartley's book back in 1929, showing the original work for the ABCD patterns on the original trend, here being a Gartley sell pattern that would have completed back in 1930 in April. So now let's go to the go to the live charts here for the moment. We'll pull this up, and this is the ES mini contract. So let me first, since 328, let me take a look at what's written in here. So we've got, Steve, the UNG trade, how did you come up with the entry level and it still looks weak? Would it be wise to sell it now and buy it back cheaper? Dave, no, I don't. I like the trade. We'll go ahead and pull that up, and I'll show you how I came up with that. UNG again on a 3-monthly. Are we doing more volume than the last low of 498? What we're taking a look at really on the UNG is actually the natural gas contract. To be able to base the trade, that's what the underlying instrument is. And the actual monthly chart that we're taking a look at, when you say a 3-month, if you're just going back and taking a look at the month, what we actually did, and Tom had access to it, I did not have the historical data, so I was using the Bloomberg system to take a look at that trade, and these were going back to lows going back, I can't remember how many years, 10, 11, 12 years, 20 years, something like that. So these were lows that were being tested from back quite a ways. But let me go ahead and pull up UNG right here so I can come back and answer that question. And what we're really taking a look at is breakout areas. So let me see if I can do this. There we go. So what I'm going to first do on UNG to answer that question, you've got the breakout that we had. We did have a gap that I was aware of. And so if you take a look at the breakout from January 23rd, the low on that was 523. Now what I'm going to do here is I'm going to just simply come down to a 30-minute chart. In a 30-minute chart, let me go ahead and erase this stuff here. And so we start over. This is where the breakout occurred, and you can see that the breakout on this candle right here is a low of 527 and a high of 540. Off the top of my head, well, I think our entry point was at, 537? Is that correct? 537? Maybe somebody can confirm that. I can't pull that up on my screen right now. But it was basically as it was coming back into this candle right here with volume. If we take a look at and we go across as it was coming back, and yes, it was gapping down yesterday. When I did get off of the, so 537. So it was really nothing more than paying attention to the original breakout, 527 to 540, identifying a entry point, and just simply came up with a few. I probably, if I go down to a 10-minute chart, I don't know if that exact number showed up or not. Real quickly, yeah, here was the breakout. Here we go. So here's the answer to you. All you have to do is just back up a little bit further. So when we take a look at the 10-minute chart here, so at 9:40, it opened at 527. The high was 537 with that volume bar. As it had volume coming into it, I simply took a look at the high of this area as the place for us to enter the trade, and that would be with it coming back to the breakout area. And that was the reason for that. If we just simply go from the low down here up to the high that it made, what you can also see is at 536 is where you had the 0.618 retracement. So it was just simply another confirmation as the UNG started to make a pullback. Because, the 0.618 area is a good place to take the trade. You never know where the exact entry point is going to be. Instead, what you're using is probabilities. In this case here, we were taking a look at breakouts, taking a look at the 0.618 retracement. They were coming in line with each other, and then taking a look at the average true range. And the average true range, when I just simply used the 537 as an entry point, and we used a 1.618 expansion of the average true range, that gave us a stop below the actual low. And so with this being a breakout and the low being down at the 503, our original entry point, our original stop, I believe, was around 494, somewhere right around there. And so therefore, to me, this was a good probability trade. Now, we didn't risk a full 1%. We only risked 0.75%. I did get a number of emails because many of you saw the gap down yesterday, and so you had a question whether or not you should be in it, which was great. And so I responded back to those emails and then sent out a newsletter that gave instructions for folks that did not enter the trade because they were just simply trading it live or watching it live, and gave you the instructions on how I would have traded based upon that new piece of information. And that still, to me, seems really very solid. And we'll just simply flip back. So does that help answer the question with regard to how I identified the entry point on the UNG, Dave and Bill? So hopefully that does. So now what we can see that it's doing is, you broke out with volume here, 26 million shares. You're pulling back with 50 million shares, so almost 51 million shares. You're coming back right now with 26 million shares. That's really what it is that you want to see. It is coming back into this same candle here with the same volume. It may go, look, this trade may not work. So all of the trades that we enter, I don't know if they're going to work or not, but I did adjust the stop down at the moment. One, knowing that we had risked less than 1% of our capital, that also gave the flexibility in something like this to be able to go ahead and be able to and make a stop adjustment. Which if we end up getting closed out, we'll be in that 1% range with regard to our loss. But I actually still like the trade here on UNG. If you're not in the trade, I would recommend going ahead and getting in on the trade here. So that's for UNG. Okay, now let me switch over real quickly. I'm just going to take a look at one of the emails that was sent out. It was it's asking, so I'm going to try to make heads or tails. Says it seems like a runaway freight train with the market indexes. So I'm just going to switch over to the futures here, because that's really what the question is asking about. And I'm going to go ahead and I'm going to pull up the NASDAQ futures, and we'll punch that up on the screen here. And so the question is that it looks like a runaway freight train. At this stage, I don't see anything running away just yet. I'm hoping that the train decides to run away one way or the other, which is why we have the buy stop on the TNA. Because if it does decide to run away, I think the TNA is the area where or the small caps, I should say, is where we'll see the largest expansion. And the question is, so when do we enter a short? Should we enter the short now at the 1.618 versus the 1.272 expansion? And that certainly is a possibility and something that we would have to be aware of. And the other question is what are the indicators I look for? MACD history, slow stochastics, and the answer is I do not use the MACD and the MACD histograms or the slow stochastics when I am taking a look at entering a trade. I am looking at candle patterns to see if there's some type of candle pattern that's going to confirm near the either near the retracement area or near the expansion area. In this case here, when I take a look at the market, so I believe the question was, basically the question is, when should you enter a short trade, and whether or not, in this case here, if we take a look at the NASDAQ futures, and I was pointing this out, I believe, in this morning's show. So I'm just simply going to come down here from October 27th to that October 4th area. And it really becomes that's where you use the position size calculator, if you will, and determine if you have a failure, in this case here, if you have a failure of the 1.272, and what I want you to know is that we have not had a failure today, even with the market being up. You can see here that the exact 1.272 is 24.83. And we're trading at 24.86. So in my estimation, we have not had yet a failure of this pattern. When exactly will we have a failure, or will we have a failure? I don't know what that's going to look like. I only know when we see it. But that is why we've also traded here with a buy stop on the small caps. But the period where this thing could easily run, if this area does fail, what you're looking at is 25.77 versus 24.83. So you're looking at a 100-point move. And with inside this 100-point move, there is going to be plenty of room to go ahead and be able to get in on a long trade if this area fails. And the 0.618 of this expansion is not necessarily where this thing needs to trade to, because what you also want to do is you want to take a look at other swing points and expansions of other swing points. In this case here on the NASDAQ futures, what you would do is you would come all the way back to the July 27th highs, and you would go ahead and take your Fibonacci ruler and come from the 20, or at least I would, from the 27th highs all the way down to the low that was put in on August the 9th. And if we shrink this down here, what you're going to see is you've got this 1.272. So if this 1.618 doesn't hold, and let's say we get into a long position, some of this is going to be also dependent upon, are we coming into a full moon? Are we coming into that week of February 14th where we showed the conjunctions, the conjunctive period that's going on? And what we would do is we likely would go ahead and issue we just simply would tighten up our stop. And if our stop got taken out, so be it. Otherwise, let it run. So we would use that as a trailing stop, as one of the methods. But some of it is really going to be trying to take a look at each of the indexes, each of the ETFs, and see what they are telling us. So let's switch over here real quickly to the futures contract on the Russell and just see let's take a quick peek and see what we have going on here. And the very first thing I'm going to do is do a retracement coming back to the highs back in May, all the way down to lows that were here in October. And so this pattern here will have failed when we get above 813, in my opinion. So we're at 804 right now. And on the TNA, let me just try to punch this in here because I've got a... Can somebody tell me, what was our entry price on the TNA? I should have a printout of it, but I don't have it in front of me. Can somebody maybe look that up? Let me know where we're at on that. So right now it looks like the TNA is trading out at 57.83. 60. Okay. So, we've got, we still have quite a bit of a move here. And what we do have going on, we do have these multiple patterns. So we do have this 1.272 butterfly, and we do have this Gartley pattern that is set up right here at 0.618, 0.786. I apologize. Let me do this. You change the color there. So we do have these two patterns here that are setting up. Now, it's a 0.786. It's a 0.786 Gartley pattern, and when a 0.786 Gartley pattern sets up and they fail, what they typically will do is they will turn into butterfly expansions. And so what I mean by that is that you will first end up doing a move of a move, meaning the failure here will take the small caps up into the 872 area. But because we had both a 0.786 Gartley setup and because we had a butterfly setup, that what this indicates to me is that there is absolute underlying strength in the marketplace. Whether or not there's money sitting on the side or what have you. This pattern here, if I just traded this pattern, I disregarded all other pieces of information. When I see a 0.786 Gartley sell or buy fail, that what I immediately am taking a look at is where is the 1.272 expansion of that. And the 1.272 expansion of that takes the Russell 2000 futures contract up to the 946 area. So knowing that that is our likely target if the market decides to move up, coming in and buying the TNA at the $60 mark, to me means we allowed the market to prove it to us. Especially where we've had a market that is up 150 points, down 150 points the next day. That to me, this is the better trade, because the reality is what should happen, what should be happening here, is we should be seeing a market turn with this many butterflies that are out there or Gartley patterns. We absolutely should be seeing a market turn, but we haven't seen that. We have the other indicators out there. When we just simply take a look at the indexes. What the larger money fund managers are taking a look at. They're taking a look at this. Oh, okay. They are taking a look at this golden cross. Some folks are using the simple moving average. I use the exponential moving average. So we have this area here. What the S&P needs to do is it needs to break above this descending tops. We are just simply trading in this triangle. Has not even been able to break above that today. And, we may trade in this here just simply for a couple of more days. And we do get a break above this area with some type of conviction, then the market is going to want to move higher. This is also, in essence, a 0.786 Gartley. It says 0.841, so it's a little bit higher than that. And if you were taking a look at where the S&Ps could go to, you could also use a 1.272 expansion of that. And the 1.272 expansion would take you up into the 1400 range on the on the S&Ps. So, how about some other questions? And hopefully, I didn't confuse you by going through that process. Any other questions right now off the top of your head? Did you enter YCS this morning, or are you waiting on 39? Absolutely waiting on 39.81. Waiting on 39.81. Now the biggest problem with playing. Let me go over to the currency markets and take a look and see what's going on here. So let's pull up the yen. The biggest problem with playing the ETFs on the currency trades It's just that you've got the currency trading, 24 hours a day, and we just simply don't have that same luxury when we're playing the ETF. But when you get to a point like this, with regard to the yen here, and when I take a look at this yen trade and what it can do in overnight hours, this is this bearish engulfing candle. What really should likely happen here, folks, is the bottom of that ought to be touched. When the bottom of that gets touched, I think that's when we would see the Japanese finance minister step in. So you see it did a 1.272 expansion of that swing point. Let me just try to delete some of the stuff that's out here so I have a clean screen for you to take a look at. And we'll start off. So you saw that was a 1.272 expansion, and that held. And we are still in here with the move down. The part of this trade is not just so much based on patterns, but really the patterns of what the Japanese finance ministers have done a couple of times right now. And it is really difficult in Japan when you have such a strong yen. And so when I take a look at perhaps a more ideal trade for us with regard to this pattern, I'm really looking at the 1.618 as being the area where the Japanese government would step in. But the problem is they could do that. Could happen overnight. Could happen at 2 in the morning. Could happen tomorrow some point in time. This could go on for a little bit. And so this is really the area at the 1.618. And so if I pull up the YCS here, and we take a look at the YCS, what you will see is I basically took the same set of swing points, and I went ahead and took a look at where the 1.618 was, and that came out to this 39.81 area. That's for the entry price. Yes, the low on this got down to 39.95, and I'm really trying to catch this for us. I will say that if I were trading this currency pair, which I'm not at the moment, but if I were trading this currency pair, my entry point would be at that 1.618 underneath that bullish engulfing candle. That's where I would enter the trade, and I would risk, probably 50 pips or so, about $500 per contract. So I say we be patient and we wait, and if we do have intervention as we have the last couple of times out, we will probably be in and out of this trade very quickly. Hopefully we're able to time this properly. Could you take a look at the transportation index? Yes, let's see. With the DAX reaching a Gartley sell, do you think it increased the probability of a down U.S. market? Let me switch over here real quickly to the world. And it's hard to say if that's the case. If we do take a look at the Gartley, what you're looking at here is really this this pattern. Let me try to get rid of a couple of things and clean it up, and then we'll come back to it. Let me get rid of these Fibonacci areas first. So you've got the ABCD pattern that is out there, which we can all see. Yeah, let's get rid of that first. Okay, so we take a look at the ABCD pattern, which our markets have completed. And when I take a look at the DAX and how this thing finished up towards the high of its range, and if I just simply come all the way back to the May 2nd area, and we take a look at that swing point, the May 2nd area, yes, we finished above the 0.618, if you will, coming up there, but it's close enough for our work. I'm not trading I guess the answer to your question is I'm not trading the U.S. market off of the DAX. I'm paying attention to it. But I think more likely the target on the DAX ends up really being the ABC. Doesn't mean that that's what has to happen. But, what you also want to do is you want to take your expansion from your B to C point. What you always want to do, what I find it best to do, is understand where these numbers are coming together. And so you do it from the more significant swing points that you have out here. In this case here, you're looking at the October 28th all the way down to this low right here, and just simply taking a look at where these numbers come together. And so, you're close to a 1.272 at the 6720. Still has some work to do, because it's 104 points up in the DAX. And I think that if it's going to go ahead and get up to that 104 points, it'll get up to the 6830 level. Doesn't mean that it has to do that, but that is what the easiest way to answer it is I don't know what the market's going to do, but we are at such an excellent time to have to be able to use buy stops to enter trade. So both from the short side or the long side, and because our entry points are far enough out of this range, other than a massive gap that we possibly missed. I mean, a crash of 1987, something like that. We'll get picked up along the way. And so I can, I hope that everyone has both of those orders already in advance in place, because now it's just a matter of sitting back. And I don't need to, it doesn't matter to me which way the market goes. And I tell folks that all the time, that I'm not bullish or bearish, other than maybe while I'm in a trade for a period of time. But I love this opportunity here where you've got these patterns, you can use the average true range, you can use the position size calculator, and with regard to something that look, the reality is I hope that these patterns fail, because I think we have more potential on the upside than we do on the downside. Maybe that would help your indication. I think with regard to the way that these, when they do fail, that they go into an expansion, there is more potential of an upside move if, in fact, this fails. But I have no idea whether it's going to or not. Does that help? I wish we had verbal. I wish there was some way right now for us to be able to have the verbal piece of it. So you just simply have to type it in. So let me go back to the. Could you take a look at the transportation? I can. Kent, tell me what it is that you want me to take a look at, and then I can. If you help me out there. So I'll wait for Kent to type that in while we take a look at the Dow Jones Transportation Index here, which is what I have up on my screen. Just do some quick calculations here. So I'll just wait for Kent to type something in there, because I don't know what you want me to look at. There we go. No, not. So Dave Cash, Steve, what's your gut telling you on the next downtrend? 1340, 1350, or is it low volume grinding up? Not giving you clues. Hopefully, Dave, I've answered that question with regard to my thoughts there. It's just simply we've got trades on both sides. We're going to let the market pick us up, and then we kind of go from there. Can you talk about GBG trade, and are there any changes ahead? No. Can't. The high volume bars. High volume bear. Hey, Kent, help me understand that. Is it bars? High volume bars? GBG. I'm going to pull up GBG. Steve, can you look at IBM? Let me go back to the GBG, and then Kent, just help me one more thing that you're looking at there. So GBG here. GBG, I take a look at this, is really, now this is a beautiful trade right now here. We're still up over this sign of strength here, which is nice. This should act as resistance here, 121. I am taking a look at GBG, folks, as I want to be able to ride this one out, if we can, all the way up here, all the way up to that June 17th area at the $1.73. We'll see as it's approaching that area how things look. But this looks like a really good trade for us. If this thing were to pull back, and it were to pull back on lighter volume, we would go ahead and enter another position on this trade, at least at this moment. But this is our target area here, and at this stage, I would like to let it run. I am not seeing any signs of weakness, any signs of selling in this equity at the moment. Kent, the high volume. So Steve can look at IBM. ZSL. I am not right now. I'm not a fan of being short the metals. I am more a fan of being long the metals if we get a pullback. and the ZSL would be going short silver if we do pull up the silver contract. And part of that reason is maybe a little bit of a fundamental issue out there with regard to just simply the strange things that can happen in the world. If I pull up the silver contract here, I think there is more likely, this sell-off that we had here in silver, some of that was because of some of that sell-off there was because of the changes in the margin requirements that were out there, and that was a forced liquidation. So we had some of that. Some of that sell-off may have also been, some sovereign debt issues. Maybe, when you're a country and you need to pay your bills, sometimes you sell off some of your assets. If you were going to take a shot at shorting silver, wait until these areas up here get tested where you have what should be some resistance, and just simply don't risk more than 1%. But I am more a fan of buying than I am of selling the metals on a pullback. 355, so I'm going to have to wrap this up here real quick. If I take a look at IBM, I will do that. And IBM, at this stage here is the question, Mike, are you trying to short IBM or go long at these highs? If we take a look at, yes, okay, I'm going to take a look at being a short. Okay, so what you've got to take a look at right now, all this is done is doing a swing point test. So it's coming back to December 9th, 4.8 million shares. You got up over today. You got 4.7 million shares. There's too much volume in it. What you would have loved to have seen today is for IBM to have gotten over 194.87. I don't think it even did that today. 194.81. You need it to really get above the swing point. I take that back. You need to get it above December 7th. So, Mike, what you want to do is you want to take a look at December 7th. You want to see IBM get above 194.05, and you want to see it do it on about 3 million shares. The lower the volume, the better, and then you could take a stab at it. Here's the problem right here, sticking right out at you. Your short is going to run into the January 12th area of 12.8 million. So I think you have too much support in IBM to take this as a short. And this is one of those equities that is, owned, 75, 80% is institutional ownership. And so you've got too much support right here. You would rather, this high volume bar should be something that would scare you off a bit from taking that trade, Mike, okay? Well, folks, it has been great as usual. And please, if you have any questions, always give me a call or send me an email. And have a great day. I'll look forward to talking to you tomorrow morning. And have a great afternoon. Bye-bye now.